One of the issues in the banking world today is Tier 1 capital. You hear it day in and day out again. This is kind of a historical play, taking us back 3 years and where we're at the current 331. While most institutions, their Tier 1 capital ratio has been falling off, which caused a lot of banks to get TARP and external funding, we continue to grow our capital base. The little drop-off here in the first quarter, obviously it's a percentage of your outstanding assets. With a $30 million growth in assets in the first quarter, it's purely a mathematical calculation. There was nothing negative that caused the number to fall down. So in that Tier 1 capital ratio, a well-capitalized bank is considered anything above 6%. So we're above that. The new 6 that's being rumbling by the regulators could be an 8. And if it turns out to be an 8 after all this dust settles on what we've gone on for the last couple of years, again, we're in a great position. Tier 1 capital ratio to risk-weighted assets, and looking at our actual exposures on the risk assets, again, any number above 10 is a very solid number. We're in great shape there. And the bottom line is the total risk-based capital, risk-weighted assets. That's where we add back in the allowance for loan losses into the equity side of things and do calculations, so we're above 12%. Bottom line, in all three categories, our numbers are very solid, and we're in a great position to move forward here in 2011. Obviously, an impact on the equity balance is the future and the earnings of the bank is the delinquency. Our numbers appear to have peaked. Signs of improvement early here in 2011. Our loan portfolio, the delinquency has always been below peer, and we seem to have gotten through the Great Recession, as we termed it, better than our peers in the community banks and folks around us. So we had the climb that everybody else did, but we seem to have leveled off and started a decline here in early 2011. Charge-offs continue to reduce. After highs in 2009, our charge-offs improved dramatically in 2010. Are trending much closer to our peers over the last 2 years. Obviously, again, persistent collection efforts, enhanced solid credit standards, they all play into, if you're making good loans and you have good collection practice, the charge-offs kind of right their own ship. Unlike some of our peers who are kind of praying for a miracle and hoping some of these bad loans will rectify themselves over the next 6 months to a year, if it's bad, it's bad. We take the aggressive approach. We charge it off, get it off the balance sheet. We take it in as recovery. There have been months recently our recoveries have almost matched or exceeded our charge-offs on a month-to-month basis. So our balance sheet, I will tell you, and particularly in the lending side, is pretty pristine compared to the rest of the world. We're not doing a lot of rewrites and extensions for the sake of getting them off the delinquency portfolio. Conservatively controlling the allowance for loan losses, it is above 2%. Even though we had in the prior slide some pretty extreme charge-off numbers, we continue to add to our allowance for loan losses. It's just to give us a better percentage, and we're at an historical high, staying above that 2% mark. Again, improved delinquency and charge-offs in 2011 kind of led to the decrease at the beginning. We have always, for the last 3 years, been above our peers, and we're staying in that position. This is one that's kind of a catch-22. The regulators would love to see this number as high as possible, yet the auditors on the other side don't want us sheltering income and playing the game. They want it to be really a ratio, and Lorinda's got a formula that covers about 6 pages on how to calculate this, so we're playing it by the book, and it moves up and down accordingly to what's happening in our loan portfolio. One of the other big significant issues for a lot of our peers out here today is the REO, real estate owned by the institutions. I've been called by brokers all over the United States that want to do auctions for us, and we've never had a capacity or enough of a problem in real estate owned by us that we've ever felt we needed to turn to an outside source. So instead of bundling up homes and stuff for external auctions, we've been in a very, very good shape. And before we take an asset into an REO position, where we actually take it out of performing assets and put it onto our balance sheet, we'll go through and actually classify the loan, do a current valuation of it. So when it gets into REO status, it really is at what we believe is the fair market value at that point in time. A lot of folks will take the whole balance, move it to REO, write off the difference at a later point in time, again, pushing those numbers forward. We take it at the time. So even though our percentage is a 0.4, we don't really feel it's going to be a source of any consequential losses for us in 2011, that the number is solid and it really is at a fair market value.